Our initial strategy. Our initial strategy was to make minimal trades and focus on three main stocks, two of which we would hold a long position with throughout the duration of the assignment, while the third would be our riskier stock, where we could use different trading strategies such as the dividend pricing strategy. Our two long position stocks allowed us to take advantage of herding, a type of investor behavior. We would select two large capital companies whose stock price had shown a constant upwards trend. We also decided upon selecting stocks in industries that have been long standing and the economy has a lot of confidence in. We then used the dividend pricing strategy. Each week, our group would collectively decide upon a stock that was a week away from its ex dividend date, with the assumption that the price would increase before the payment was made, and then we could sell prior to the payment at the price at its highest, making profit.
We chose our stocks based on two different strategies, the first based on long position for well-known stocks and the second on high dividend yield paying stocks. To select stocks for the long position, we scanned the market for well-known large-cap stocks traded on the New York Stock Exchange, which did not have an ex-dividend date during the assignment period as to prevent drops in share pricing which would not benefit our portfolio returns. Of those stocks, we looked to see which had recent positive investor sentiment and which had pricing upside from technical analysis, which showed strong uptrends in pricing over the past 6 months, and which had moderate or strong buy recommendations from stock analysts. Our initial shortlist for the longs position stocks contained the following: Shell, Delta Air Lines, Tesla, Walmart, Oracle, Johnson and Johnson, Cloudflare, Royal Caribbean, NextEra Energy, and Total Energies. From these, we chose Shell plc and Delta Air Lines, which we purchased at the beginning of the portfolio period and plan to hold for the duration of the assignment. Shell plc was currently benefiting from record high resource prices fueled by the Russia-Ukraine conflict and the squeeze of supply chains across the globe, which contributed to our bullish sentiment on this stock. As for Delta Airlines, we assume that given the positive economic outlook in the US, many Americans would be traveling for vacations, which was likely to result in strong financial results for Delta Airlines and could increase the price even higher than it currently was. To select high dividend yielding stocks for the short-term long position, we scanned the market for stocks traded on the New York Stock Exchange which had an ex-dividend date toward the end of the week we were trading in. Of these, we chose stocks that had a dividend yield greater than 6% to attempt to profit from the temporary price spike from dividend chasers. A short list from week 1 is shown, and from that list, we chose Armada Hoffler Properties with a dividend yield of 7.75% and a 6.3% upside from pricing, from current price to analyst price, and a moderate buy recommendation. The shortlist for week 2 is also shown, and from this we chose the Altria Group with a dividend yield of 8.42% and a 6.5 upside on pricing, from current price to analyst price, and a moderate buy recommendation. To select another stock for a long position, we use the same criteria as before, given that our return on investment on Shell and Delta Airlines was above 7% at the time. We found that the shares from our initial shortlist were a good choice to choose another stock to invest in. The remaining stocks are shown. From this list, we chose the Royal Caribbean as we assumed, given the positive economic outlook in the US, many Americans would be traveling for vacations, likely to result in a price increase for the Royal Caribbean. In the days leading to the end of our assignment, we decided to select a stock to short. We decided to select a very well-published, overpriced stock on the New York Stock Exchange over the past 3 years, which was GameStop Corporation. We did not actually screen this stock per se by purchasing based off common market sentiment regarding the short squeeze in early 2021, assuming the price would continue to drop over the remaining days of the assignment.
Throughout the trading process, there were strategy changes. So one of the changes was taking on another long position. So after 2 weeks of the assignment, it became apparent our dividend pricing strategy was not working as we envisioned. As such, we decided to purchase a third stock that fit with our initial long position strategy to attempt to realize similar returns from this stock. This did not work as well as the first two due to the overall dip in the market related to inflation figures released mid-April by the Federal Reserve. Another strategy change was taking a short position. In the last few days of the assignment, we changed strategy again, attempting to find a stock to take a short position on, make returns, especially as the wider market was suffering from the inflation announcement by the Federal Reserve. We saw this as an opportunity to ride the negative market sentiment to realize additional returns before the end of the assignment.
When we firstly decided upon the stock Amanda Hoffler Holdings to take advantage of the upcoming dividend payment and the positive market sentiment, we had unfortunately not predicted that the price would increase a few days before the ex dividend date, missing our chance of a profit as the price had dropped before the dividend payment was made. We then attempted with Altria Group the same strategy, but sadly had no luck as the price never increased and only fell prior to the when we decided to change our strategy and short sell the stock GameStop, as the stock price for this company had fallen by over 80% in the last 3 years. However, we were looking for a quick drop in the stock price, and GameStop was much less volatile than other stocks. This is when we saw the price just slightly go up and it didn't fall before the end of our assignment. If we had held a long term position for short selling GameStop, we would have seen a much better outcome.
Efficient market hypothesis, EMH, theorizes that markets are efficient and that all available information is incorporated into asset prices. If EMH holds true, then it would not be possible for an investor to consistently generate abnormal returns compared to the market index when considering the risk profile of the portfolio. Any abnormal returns for our portfolio would indicate luck or the purchase of investments that were risky, generating higher return. If EMH does not hold true, then it would be possible to consistently generate abnormal returns to outperform the market index when considering the risk profile of the portfolio. This could be done by selecting mispriced stocks based on research, fundamental analysis, or technical analysis, or by exploiting irrational investor behavior.
So findings of EMH in our portfolio, evidence supporting efficient market hypotheses, EMH in our portfolio. So news affecting stocks. All stocks within the portfolio appear to react quickly to new information that is made available, noting an increase in trade volume at these times as well. This information supports the semi-strong form EMH. For example, Shell Nigeria struck a $3.8 billion deal for a methanol project. Reported after close on the 18th of April caused the stock price to climb to 1.46% higher at closing the following day as seen in Figure 5. So as seen in Figure 5, at the 18th of April, Shell price was at $71.03 per share. And when the news got released on the same day, the Shell price steadily increased throughout the day and it increased 1.4% to $72.07 per share. In conclusion, stock prices reflected all public information supporting semi-strong form EMH. So findings of the EMH in our portfolio. So evidence refuting efficient market hypotheses, EMH, in our portfolio. So market overreaction, when prices overshoot and then return to a new equilibrium after new information was released, indicates inefficiency and refutes the EMH. For example, on April 10th, 2024, the Federal Reserve announced higher than expected inflation. So initial market reaction was the portfolio and the New York Stock Exchange composite dropped 3 to 8% on the 11th when trading resumed. As seen in Figure 4, on the 11th when trading resumed, there was an initial drop in price, which plummeted up the market. And then in the week to April 19th, 2024, all prices recovered from their trough, showing initial overreaction and inefficient processing of true market price due to inflammatory information. As seen in Figure 4. So when that price started to come back up and recover, the recovery of prices above the lowest point indicating investors' overreaction. In conclusion, overreaction to inflation data indicates market inefficiency and refuting.
EMH is based on the premise that all investors within the market act rationally, resulting in accurate pricing. Investors acting irrationally or with biases can lead to mispriced stocks and refute EMH. Overconfidence, herding, confirmation bias, and loss aversion bias are some common biases and irrational actions taken by investors. In our portfolio, there is evidence of herding behavior by other investors where Shell and Delta stock prices appear to have increased independent of new information, instead driven by investor sentiment. Although this refutes EMH, our identification of herding may actually be confirmation bias rather than true herding events. Some examples of irrational investor behavior by our team members are overconfidence, belief that long position prices will definitely increase, and loss aversion bias, not selling falling stocks, disregarding opportunity costs of other assets. These irrational behaviors support market inefficiency, contradicting EMH, but how much does this truly affect asset prices? There is evidence both to support and refute EMH apparent through analysis of our portfolio results. However, when analysing all information throughout the assignment, it is our opinion that there is sufficient evidence to support EMH closest to semi-strong form. This is due to the speed at which stock prices react to new information and the apparent randomness and lack of predictable patterns in stock pricing. While we do feel that we beat the market through informed decision-making and sound strategies, luck played a large part in our portfolio results. We believe our portfolio would not consistently outperform the market index in the long run, supporting EMH and indicating passive investment in indexes is a sound investment option for the future.